Hi, I'm Charlene Laney, co-founder of Newmaker Financial and certified financial planner. Today we will be addressing the question of, for backdoor Roth contributions, if you happen to already have a rollover IRA with a substantial amount in it, should you or should you not simply take the tax hit in order to allow for future backdoor Roth contributions? Now, you may be wondering, what the heck am I even talking about? Well, it has to do with some certain IRS rules around Roth IRAs. So I'll break those down to you really fast here. If you are a high earner, meaning that you and your spouse jointly, married filing jointly is your tax status, right, make more than $228,000, that's the threshold for 2023, and the threshold for single earners is $153,000. That means that you're actually not allowed to make contributions into a Roth IRA. So sad. There is, however, a completely legal loophole designed to help you make contributions into a Roth IRA. And it involves, this is what's called the Backdoor Roth IRA. It involves contributing first to a traditional IRA that is empty. We will call it a pass-through IRA. And making that contribution on a non-deductible basis, then immediately converting those funds into Roth. By the way, if you're doing this, you will need to not forget to file the Form 8606 in order to designate your pass-through contribution as a non-deductible contribution. The huge asterisk to this process of backdoor Roth contributions, of course, comes up if you happen to already have funds in a rollover IRA or a traditional IRA of some sort. And the reason for this is because if you are contributing some but not all of your traditional pre-tax IRA assets into Roth, the IRS unfortunately doesn't view that as a dollar for dollar conversion. You've run into what they call the pro rata rule. Not all of it will be converted. And this is sometimes referred to as the cream in the coffee rule. So how do you get around it? Well, we try to eliminate what you have in a rollover IRA, in a traditional IRA, and convert all of those assets to Roth, or you move those funds and roll them back into a qualified employer plan like a 401k, assuming that that is even an option for you. Now, for folks who are considering more the former option, which is to get everything into Roth as soon as possible in order to allow for those future backdoor Roth contributions, the question is, should you just take the tax hit here today? For most folks who are younger, not necessarily at their peak earning years, and perhaps even are going through a year where you're making a little bit less than you normally might. Maybe a spouse took some time off of work. Maybe you are in between jobs. These are certainly years where your income is a little bit lower than normal, that you would want to consider doing this for the purpose of future backdoor Roth contributions. Now, this is all going to be dependent, of course, on your tax situation, on your individual goals. As financial planners, we cannot give you direct advice for tax purposes on what to do, but we can certainly walk you through different scenarios of what could happen and what could be best for you based on what you share with us. So certainly not intended to be direct advice for you. Talk to the professionals, talk to your tax advisor, talk to your financial planner. But yes, one thing to keep in mind is if it is a lower income year for you, lower than normal, then that would be the time to consider it. And then, of course, we have to take into account other factors, like how much exactly would we be converting from pre-tax into Roth? And these are all conversations that we have with our clients on a regular basis. So hopefully this has been helpful and that you've learned something. If you haven't yet, please like, share, and subscribe, and we will see you next week.